Okay, guys, how's it going? Here we are, Thursday morning. It's the 13th. Oh, what is it? About 10:30. So I mentioned I'm gonna start a little bit early because I'm doing the webinar for Ninja this afternoon at 3:15. Well, it's 3:15 my time. I hope you guys can join us there. It won't be so much that it'll be new content for you guys, but perhaps just a different way to look at it, because we'll be doing it, of course, exclusively on Ninja as opposed to TradingView. So I hope you guys can join me there. Again, that's 3:15 Central or 4:15 Eastern time. All right, let's carry on here. So AMD was the clear winner in the trads today. So as I said, I'm going to start early. Does anyone even close? It was good participation, but AMD is the winner. And now I'm going to do this with options, not so much because I'm, trying to overexpose you. Or it's just, as I look at that chart, I mean, I wouldn't go near the underlying, right? So this is, again, I keep talking about options being just another set of tools for the job. So you guys are interested in how to trade this. Well, just looking at it, I think it's reasonable to say that you're, well, of course, right, there's no limit to how far this can go. You're a bit late to the rally here. Now you've been through earnings. Next earnings were not until October. But talk about going up in stairs, right? This is just remarkably technical. It's just astonishing, right? Still, right? 28 years of doing this, it just blows me away how it. So we're going all the way back here to, it's just prior to this is end of December. So we get our 1, 2. Note, and of course I had to go to log scale here on the daily chart so we can get the framing here. 1, 2, 3, 4 sure looks like an extension in the fifth. I mean, not hard to spot this. I mean, really, sometimes it looks like, it can't be that easy to spot the count, right? I mean, it looks like something you'd pull out of a Elliott Wave for dummies. So I mean, it really is astonishing how technical this is. Now I'm going to take it out of log scale here because we're going to just focus on my proposal here is that we have an extension. So a couple of things here to note. Now once we get going, look at how the Vegas wave supports this. Right? Just beautifully. Right now we get underneath here a little bit. But so you look at a couple of things here. One, how the structure has played here. Prior resistance becomes support. It's resistance. Now, we don't quite make it, but it's pretty damn close, right? And it's technical on that retrace. So you get this little nugget right here. Get it right on that. With a little front run on that. But look at the 233, right? Just beautiful. Now, here's what you notice here. Look how far we are from the Vegas wave. I mean, we are. So I can appreciate the thinking here. Okay, well, you've got a raging bull trend here going. Now, how do you participate in this? Well, okay, so you got to look at it and go, okay, well, do I want to be a buyer here? I mean, I'm not being facetious there. I mean, really, would you want to buy that? And of course, I'm not suggesting that we couldn't be at 300, sometime next year. But just looking at the chart here. And just how far we are from the Vegas wave, it would suggest that perhaps the opportunity here is for something to come down a little bit. Maybe we get our 4 here and then we go up. So we're looking for down up, which has been very consistent in everything we've looked at lately because we have this raging, ripping, Fed-driven, easy money, take all you'd like, if you're a corporation, kind of a policy stance. So how would you trade this? Well, again, we come back to what's the right tool for the job. So if you think it's overvalued, well, sure, you could short the underlying. You could, right? If you think it's just going to keep going, you could buy it. Now, where's your stop? Where's your stop if you're a buyer? Well, that's a pretty good rip right there. So now, of course, note also all the gaps that we have here that are likely to get filled at some point. Big one here, big one here. So just looking at this little gap right here, right? We just kind of wick that off here. That, it's going to be a magnet to the market. So just in terms of the Elliott count, now you get a shallow, probably, it looks like a flat, right? So you got your A, 3 into the B, down for the C. So it looks like you get it really looks like a flat, right? So it's just sideways. So 1, 2. Well, that's going to be the 3, most likely. Well, so you say, okay, well, are we sure about this count, right? Is these ratios? Well, just for fun, let's just take a look at it. All right, let's just focus on the extension here because we don't need to go back to 2017. All right, alternate projection tool. Let's just check it. Just out of curiosity. Sometimes you just let's see. So the length of the 1 projected from the 2. Where am I looking for my 3? Right, like literally right out of an Elliott textbook. Oh, well, okay, highest probability. It's going to be the 1618, 175 window. Where do we go? Okay, so that's decent. So you go, all right, well, that's a good contender. Like you'd start, you say, okay, I'm going to plant the 3 right there. All right, let's see how that plays. All right, we got a good read on the 3. All right, let's think about where we might look for that 4. All right, so we know, right? Really for a 4, your prime zone is 23 to 50. Right, but just thinking about how an algo might respond here, right? So just dominant swings, right? Swing high, right? We come down, so we know we can see the range here, and it's very easy to spot. And yeah, we get the little retrace. Note where the retrace goes, right to the Vegas wave. So up we come right down to the 50. Right, like last stand, right? So you'd have been sitting here going, oh shit, man, I hope it doesn't overlap here. I hope we don't overlap. Well, if this is the 1, 2 of this 3, well, I hope we don't overlap. Hope we don't overlap. Like it's, I promise you, it's not random. All right, so now we tag the 50. Now we blow right through, and now we get second target. So this is where we're stalling. So in the raging, ripping bull here, they don't even pause at first target. They're just all the way to third. Now we get our little retrace. So let's open that up here. And again, I'm just trying to keep this drop dead simple because it really is that simple. Okay, so you say, all right, I got the 3, I got the 4. Okay, 1, 2. Well, that's likely, unless we're going to have a double top here. That's right. Once we break this high, we can just deductive reasoning. Okay, well, it can't be the 5th. So what else could it be? Well, it looks like I got a nice 1 here. How about the 2 here? Let's go right to the 2. Get that right on there. Let's make sure I'm right on that. Get on these pivots. Just get it just right on that. Okay, let's pull it back out. All right, where are we looking for the next third? Right, now this actually gets a couple of ticks past it, just a little, pokes a little bit past the 175, but you'd be fairly comfortable here going, okay, that seems like a reasonable contender for the third. Right, I just did it to the tick right here. 1, 2, do it again. Now, where are we looking for the 4? Now, note where this gap is. Right? It's like it's hard to believe it's this easy, right? Okay, so where are we looking for the 4? Right at the 38. Where's the gap? It almost looks like it's faked, right? So like somebody just did this, right? You just photoshopped this. It's not that. Can't be that easy. Can't be that predictable, can it? Check your own chart, right? I'm not making it up, right? It's the same thing, guys. It's. I know you feel like, oh, okay, well, yeah, that's every chart except for the trade that I'm in. I feel that. I understand, right? Oh, yes, always so easy in the trade that I'm not in. There's certainly no reason to anticipate anything other than this continuing, right? Why would you assume anything other than, right, until proven otherwise? Why would you assume anything other than that to go on and complete, right? If you're a student of Elliott Wave and an advocate and you incorporate it into your trading, there is essentially nothing to suggest anything but that. Now, of course, that doesn't mean that it's guaranteed to happen. But if you're just laying out the roadmap here, considering how incredibly technical this has been the entire way up, well, so if we're putting together a trade, we want something that'll take advantage of coming down here, but not to be we're not trying to short the market. We're not anticipating a move back to the 30s. We're trying to, if you're thinking about what's the right tool for the job, well, I kind of want something that'll play weakness into the 4, but then I don't want to be short. So either I got to try and time this exactly perfectly to get, okay, I'm just going to get the 4, which, ambitious, right? I mean, there's probably a way to trade. Well, shit. There's definitely a way to put together a trade that would have that profile. But don't we really want to take a little weakness here, but then not miss the final kick here? If indeed that's what we're going to get. Again, no guarantees. How do we get a 4-5? How do we? Well, of course, again, you could buy a put here, and then if you get it, take profit, buy a call here, right? You could do that. Boy, you better be spot on with the timing. Just absolutely textbook perfect, right? Or you're going to be in trouble. So how do we do that? Well, this is where options can be really attractive. So you look at this rip and you might first think, oh shit, man, the calls are going to be way overpriced here. There's going to be juicy premium up here to sell. Right? What I mean by that is overvalued options, right? So premium being the implied volatility. It's often described as the premium that is implied into the pricing of out of the money options. So anything, well, shit, what's our high here? 87. So anything above here, right? We're projecting for the 5 has nothing but time and time and implied volatility, right? It has no intrinsic value because it's out of the money. So how can we take advantage of this? Well, if we're looking for something to take advantage of a down then an up, so you're in effect, not only you're playing price, you're playing time. Well, this is a trade that I like a lot. I use it a lot, right? So I never want to be exposed or naked in terms of my risk control. So I don't want any naked options, i.e. unhedged positions. So in effect, you could say I want to buy a put here. Well, it's not that it's naked because you've defined your risk, right? So naked ultimately, as an option trader would define it, would be open-ended risk. So I don't want anything naked, i.e. open-ended risk. Now, if I buy a put here, well, I'm not naked, but I have no hedge, right? So I need to be absolutely right, not only about the direction, I need to be right about the time, right? Again, options are a wasting asset, right? So you buy, as soon as you buy it, it's like driving a new car off the lot. As soon as you buy it, tick, 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 time starts ticking away. Second you buy it, you're losing money. Pardon me, not necessarily losing money. You're losing premium value. So if we look at the options, I'll show you here. You get a daily tally of what it's costing you to rent that option. Right? You buy. So you say, I'm going to buy the put, and then I'm going to come down here and buy the call. Right? Again, well, you better time it just right, price and time. Okay, so how could we put together something that would play down then up? Well, again, I'm back to a calendar spread. Now, where I was going with that here is having a look at where the option premium is. So again, as we've looked at this a couple of times over the last week here, as I've been showing more and more of these. So the brownish line here, that's the actual volatility, right? That's the statistical volatility right here. SV, statistical volatility, is running at 69.5%. Surprisingly, right? And you often will see this in an up move, right? The option volatility is lagging the actual volatility, right? So you do not have overvalued options. You tend to get more implied volatility, right, when the market corrects. So here, the market comes down here, look at the spread, right? It's the actual volatility, implied volatility, there's the spread. Now we go up, right? You got a little volatility spike here, but as we've now cooled off a little bit and we're moving sideways, we don't yet have the option implied volatility screaming higher. So you don't have the circumstance that you might have thought, which was, oh, really juicy, overvalued, out of the money calls. That's not what you have. So with lower premium that implied than statistical, you could make a case here. This is not a bad time to be just a straight option buyer. Okay, but see, I don't like to do that because I want to be hedged. I'm not trying to, you could say, all right, I want to swing for the fence here because I think AMD is overvalued. Well, back to, do you want to fight the trend here, right? Trading rule number 1, the trend is your friend, right? Don't fight the trend, don't fight the Fed, right? Two things that we're experiencing right now, trend and Fed. Well, the Fed, it's just giving companies like AMD all the money they want, right? It's zero borrowing cost. You buy back all the stock you want. How about a few billion in PPE money? Right? So you can understand why we do this, right? Why do we do that? Obviously, the earnings here were part of that. And AMD, it's a great company. They're kicking Intel's ass right now. They're a great company. So it's nothing about the company. It's about how do I trade this thing? Well, again, do you want to be a buyer there? Do you want to be a seller, fight the trend? So how do you put together a trade? I want something that's big and fat. I want something that's going to give me a risk profile like this. Like, how do I put together something like that? Well, you're not doing that. Again, you're not doing that with the underlying. There's only options will let you do that. So let's go back to that. All right, do you want to be just straight short? Well, maybe not, right? Looking where the options are. So if I'm going to buy something, well, I certainly want to hedge it. I want to sell it. So again, a calendar spread is what I think is the right tool for the job here. So with that, pull this one up here. All right, so here's the trade that I think makes the sense and makes the most sense and has a nice fat profit curve here and is slightly skewed to the long side. So what we're doing is we would short sell 5 of the November 85 calls. Market is currently sitting at 82.50. All right, yeah, 82.50. So we're selling above the market, but we're buying the January 21 85 calls. So understand, so let me get the matrix here. All right, so here's where you can see it. Oh, let me get, hang on, let's get, so you can see the time decay. 85s, hang on. Where'd we go? All right, here we go. Okay, so theta here. So this is the legend, so you can see what's what. So bottom left-hand corner is the amount of time decay of that option per day. So I'm looking at it in November. That's losing $5.25 a day of time burn. Now, it's the 85 call. The market's here at 82, 82.42. So we're above the market. So it has nothing but time and the implied volatility, MIV, top here, top left, MIV. That's the implied volatility that the market is anticipating to support the price point of 937. Right, so so the traders that are buying that are saying, I'm expecting an increase in volatility such that this will reach intrinsic value. But to put on that bet, it's going to cost you $5.25 a day. Now over here, I'm buying, but this is losing $4 a day. So I have a $1.25 spread differential here in time burn. Both of them are out of the money. Right? Do you understand the kind of the mathematics here? So all I'm trying to do is sell here because I'm anticipating that the 4 is coming. Right? So I want this to soften here, and as the time decay comes out of the nearer option, because it expires faster, I want the time burn to come out of that option, but then I'm expecting this thing to go up well beyond 85, right? And so, but I want to give it time to do that. So I want to go out to, well into 21 for that. So back to the trade. All right, so I'm going to sell this one and buy this one. Look at the difference in time. I have 56 more days here. So if this comes down, I have the opportunity to bank my profit here. Well, I could do one of two things. If it's coming down, right, well, I'm going to be making money here. So let's look at 50 days, right? Here's 50 days. Let's go. Yeah, we're right here. So 50 days, that's going to put you're about $450, $500. Now, it's going to cost you $1,000 of margin to put this on. Now, I'm making an assumption here about the volatility increasing. Now, why would I do that, right? So if we come back to this, why would I assume it's going to increase? Right, because if we start to come down a little, volatility is more prone to spike as people start buying premium to hedge. Right, if you're long and you're in this, but you don't want to get out of your AMD long, you're going to start to pay a little premium to get some insurance. That's what you're buying, right? It's an insurance policy. So you could anticipate if it does start to come down in a 4 that you might see these two start to get closer together. So a little bump in implied volatility. Look right now, it's got a 16-point differential here. So the statistical is 69.53. So just to suggest 5% increase in volatility is not outrageous. But I could say, okay, let's say we only get a 2%, right? It doesn't, you may not make as much in the near term because we want the volatility to increase because of the options that we're long here, right? We want to see this increase over time. So we come back here and we go, okay, all right. So if it doesn't go deep, well, let's think about it, right? So how far could it go? So if it comes down for the 4 and we get this gap, well, that's 69.70. So let's go back here, 69.70. Well, if I'm going to come all the way back down here, well, I have a break even down here of about 68.69. So if it comes down there, right, I really got to decide, well, how much do I like that as the 4? If I'm coming down to this, well, again, as we drew it up, if this holds as my 2, and that's right, so we're going to come down to this range for that 4, stronger trend, you would anticipate it not going to the 618. You'd want to see it stay between the 23 and the 50, right, to carry on with the strength of trend that we have here. Now, again, of course he could do that, right? But again, there is no perfect way to trade this. You've got to take some risk in terms of what you're anticipating. So you're looking for this to come down no more than 69 before it goes up. All right, so we come back to our trade. If we come down to 69, well, you're going to be making money on that front month, right? Because this one is burning faster. So I'm going to make money here. I'm going to lose money here, but I've got another almost 2 months of time here. So I'm trying to play a perfect bank shot. Down November, losing value. right? Now I want to close out. I have the decision to make. I could close out November and stay long January, looking for the kick in the 5. But if I do that, remember, now I've banked some money on the November, but now I'm essentially, I have no hedge here, so I need to be right for the trade to catch it on both sides. So I want to make money here, knowing I lost on the January, but then as that rallies, I'm going to get it on both sides, right? So it's you're playing the bank shot. So down we come. I've still got 56 more days here. Play it down here. Bank profit on the first one. Now I could, right? If I'm down here, I could say, okay, well, fuck, I didn't get it exactly right. So the timing didn't get it just right. So I'm just gonna take my scratch, right? And then reposition a trade. Maybe at that point you want to be in something that's more bullish. So if it comes down to 60, 70, and you're still long an 85 January call, are you anticipating that much movement? What's going on with the election, it's unlikely the Fed has done anything differently. So you might anticipate, well, how bullish am I really? Can I get over 85 or back to 85 in the amount of time that I have left? I've got 56 days. Well, we know options, the time burn accelerates inside 30 days. So with 56 days, I might hang around a little bit. Maybe I don't get all the way back, right, to 85, but if I come back and I get up into the high 70s, low 80s, well, I'm going to be making back some of the money that I lost on this when it went down. Now this is going to start to come back up. So that's how I would trade. You're starting out delta neutral. Well, fairly close to neutral. So you start without a directional bias, but look at the range of profitability, right? That's what I'm trying to draw your eye to. Don't look up here. You're never going to get that, right? You don't even want to aspire. So this is the last one to look at would be right here. So if we're between 84 and 90, you're catching $900, maybe close to $1,000 there. If we're up here, there'd be $900 P&L on this trade that you put 1,000 into. Now again, you got to get it just right. But as I will often tell you, it's a much bigger target, right? This is the analogy I like to use. Much bigger target to literally target where the market is likely to be, as opposed to exactly where it's going to be, right? So if I can say, well, in the next, what do I do here? 60 days. I'm willing to put capital at risk to suggest that the market's going to be, that AMD is going to be somewhere between 68 and 100 and, what do I got there? 104. 68 to 104. If I can construct a trade that makes money through that entire range, well, I'm comfortable with that, as opposed to saying, okay, I'm going to nail this exactly right. I know exactly where it's going to be here at this time, and I know it's going to go straight up from that. Now, it may, and you would make more money if you nailed that timing. Shit, you could short the stock and then buy the stock. You're going to get paid dollar for dollar here, dollar for dollar here. You're going to make more money that way. Right, but are you that confident that you can nail that precisely? Well, if you are, great, right? I'm not saying don't do that, but I'm just showing you an alternative here, an alternative way to trade it with a much fatter profit target. That's the attraction of options, right there. Huge target. It's like throwing darts. I used to play a lot of darts. I just had a natural talent for it. So I used to make a lot of money doing that. So I don't know why, but I just had a talent for it. So it's like if you're throwing at the dart, this is like throwing at, saying, okay, I'm going to nail the bullseye 2 darts in a row. The option trade is like saying, I'm going to hit the board. I'm fairly certain I can stand here, I can throw this dart, and it'll land somewhere on the board. Now, if you've ever played darts, right, we've all thrown a clunker that went off that didn't hit the board. But you're probably a little buzzed when you did it, right? So to throw a dart that lands on the board somewhere, I'm willing to take that bet. So essentially I'm saying, okay, I'm going to put down $1,000 on the table, right? So if you were in a bar, I say, I'll put $1,000 on the table. And I say, all right, if I hit the board, you're going to pay me $900. If I lose, if I don't hit the board, well, I still get to keep my $1,000, but I don't make any money. Does that help with that analogy? I mean, I know this again. I've been saying this. Like you look at an option model. It's not sexy. It's not visually appealing. It's not like, oh man, look at all the pretty lines and this is so cool and look, it's amazing how that works and how that all. It's not visually appealing, right? It's statistics. It's dull, right? But once you learn how to read this, there is a beauty here, because if you can play this instrument correctly. This is an ATM. Okay, guys, I'm going to wrap it there. Maybe I'm going to try and do one more if I can. Okay, guys, talk to you later.